Our good friends at the League for Restorative Justice have just sent us another in their fascinating and informative series of videos about the lawsuits brought against Oasis International Group, its owners, lenders, and business associates. This new one is called the Fairy Dust Fable, because the government prosecutors at the trial of Michael da Corda, Oasis founder and CEO, called his company's profitable foreign exchange, or forex, broker-dealer earnings, pretend fairy dust and accounting trick. As you'll see, Mr. da Corda's public defense counselors compounded the prosecutor's critical misrepresentation by failing to understand, or at least to explain, how Oasis's forex broker-dealer profits were used to calculate the repayment of loans made to Michael's company under the terms of its promissory note and agreement. This video clearly explains how that so-called fairy dust was created, how it accumulated to more than $51 million in profits, and how it factored into the company's promissory note for the calculation of repayment to Oasis lenders. You're in for a treat with this one. You'll not only learn more about Oasis operations, but also why Oasis's representatives told lenders that their money was not at risk in the company's forex trading operations. You're also about to discover how often you pay transaction fees like forex traders do every time they open a trade, while the League reveals a bit of inside baseball about how forex trading works. The League promises that their next production will show clear evidence proving the fees Oasis earned through its own forex broker-dealer operations were not fairy dust, nor could they have been if the government's own figures were correct. Too bad that Mr. da Corda's lawyers didn't show that during his trial. We hope you enjoy this video as much as we did.
In this video, we're going to explain one of the features of Oasis's operations used to create the Oasis civil case and confuse the jury in Michael da Corda's criminal trial. While its significance eluded his defense counselors, the prosecution intentionally mystified it to condemn Oasis's co-founder and CEO to 23 years in federal prison. Once you understand the nature of this part of Oasis operations, you'll see clearly why its mystification was a necessary cornerstone of Michael's criminal prosecution. The elements we're about to focus on, which the prosecutor called pretend, fairy dust, and accounting trick, are the transaction fees referred to in paragraph 1 of the Oasis promissory note and agreement.
In pertinent parts, that paragraph reads, "Any unpaid loan amount due hereunder shall receive the greater of A. Interest calculated at the rate of 12% per annum, or B. 25% of the transaction fees as hereinafter defined." The final sentence concludes, "Transaction fees shall equal the fees charged by the maker upon the loan amount in its ordinary course of business through proprietary trading account of maker." In his opening statement to the jury, Adam Allen, one of Michael's defense attorneys, attempted to explain what these critically important transaction fees, called spread fees, were and how they were factored into Oasis's repayment promise to lenders. In his opening statement for the prosecution, Frank Murray conflated the fees with pips, which is the currency unit they are measured in. That's like calling a yardstick inches. He told the jury,
"The evidence will establish that in this case spread pay, or pips as they're called in the industry, was pretend, fairy dust, and accounting trick."
In her closing statement to the jury, lead prosecutor, Rochelle Bedke told the jury that her witness, Matthew Childers,
told you that the spread pay was illusory. It was a fiction. It was like fairy dust.
In our next video, we will show that spread fees were not pretend fairy dust or an accounting trick, and were not fake, but were incorrectly analyzed and not presented for what they are, genuine.
Today we start with questions that should have been asked and answered before anything else happened. As you'll remember from video number 3, ownership, everything began with the promissory note agreement and risk disclosures. Therefore, in order to sign up as a lender or properly prosecute a case against the company that issued the agreement, one must first understand its terms, which defined what the company promised and specified how it could employ the loaned funds. The correct questions to ask are: 1. What are transaction fees? 2. What is the loan amount involved in the ordinary course of business? 3. What do transaction fees have to do with the proprietary trading account of the maker? 4. How often do they come into play? 5. What, if any, value was gained from their use? 6. How are transaction fees calculated such that a lender might earn a 25% share of them? Transaction fees in the foreign exchange or forex market are the fees paid to enter a trade in that market, similar to fees paid to enter a stock trade. Forex traders call them spread fees because the fee charged equals the difference between the asking price and the bid price of the currencies being traded. That difference is called the spread and is measured in units called pips. Oasis operated a proprietary trading account, meaning that the money it traded was its own money. Video number 3. Ownership. Discuss this. The transaction fees were the spread fees charged by Oasis' wholly owned broker-dealer against the amount of money that Oasis entered into a trade position. The amount, also known as the size of the position, varied from trade to trade. As you will see, the various trade position sizes produced various amounts of revenue for Oasis from day to day. Every spread fee earned was a positive gain for Oasis because it owned the broker-dealer that charged them. By the time Oasis was shut down, it had earned $51,307,925.93 in spread fees. The calculation of Oasis's transaction fee earnings was automatically calculated at the entry of each trade and reported to Oasis by the SpotX reporting system, which recorded every element of each trade, not just the spread fees earned from it. At the end of the month, it was a simple matter to take the sum of all earned spread fees for that month and divide it by the sum of all loans held by the company. If 25% of the result was greater than 1% of the sum of all loans, then 25% of the spread fees were paid into lender accounts in proportion to each lender's share of the sum of all loans to the company. If the result was less than 1% of all loaned sums, then an amount equal to 1% of the lender's principal account balance at the beginning of the month was paid to their account. We'll illustrate this so it will be easy to understand. We each pay transaction fees throughout our lives. We just don't call them that. If you've ever bought a ticket to get into a sports stadium, movie theater, concert hall, or a cover charge to a nightclub, you've paid a transaction fee. Likewise, spread fees are the ticket to enter a forex trade. The outcome of the trade has nothing to do with the spread fee. Spread fees are simply what's paid to get into the trade. Nothing more. When you buy a ticket to a movie theater, you're permitted to enter and watch a movie. Is there a guarantee that you'll like the movie? No. Is there a refund if you don't like the movie? No. When you buy a ticket to a sports event, you're permitted to enter the stadium and watch the game. Is there a guarantee that your team will win? No. Is there a refund if they don't win? No. The result from entering the stadium, movie theater, concert hall, or nightclub is never guaranteed to be enjoyable, and there's no refund if it's not. The same holds true in trading forex. You pay your entry fee, the spread, and enter the trade. But the result could be a financial loss, gain, or a break even. In every case, the transaction fee, or ticket price paid, belongs to the owner of the venue that hosts the trade you paid to get into. In the case of forex trading, that venue belongs to the broker-dealer, which sets the price of the fee, just like a movie theater sets its ticket prices. Oasis owned the broker-dealer it placed trades through and therefore kept the spread fees paid to enter each trade on its platform. As mentioned earlier in this video, the profitable sum of spread fees from all trades taken on the Oasis platform up to April 2019, when Oasis was shut down, was over $51 million. The losses experienced as a result of the poor trades that Oasis traders made did not change the fact that Oasis had earned that much profit through spread fees. The fact that spread, or transaction fees, were always profitable to Oasis, and they appeared in the promissory note agreement as conditional interest payments without any reference to trading gains or losses, explains why Oasis representatives said that the lenders were never exposed to losses in the market. They weren't. As lenders, they had no interest in the gains or the losses that resulted from Oasis forex trading or other investment activity. But when 25% of the monthly spread fee earnings exceeded 1% of the sum of all loans, then each lender was promised a proportional share interest in that month's earnings instead of just 1% of their principal amount.
It can't be emphasized too often that lenders had no part in the gains or losses accruing from Oasis trades any more than those derived from its purchase of precious metals, real estate, or businesses. The gains and losses belonged only to Oasis's shareholder principals, Michael J. DeCorta and his partners, Joseph S. Annealy II, and Raymond P. Monti III. Attorney Joe Annealy confirmed the terms of the promissory note and agreement in his witness testimony on Day 6 of the trial, transcription pages 179 and 180, when he said that Oasis had no obligation to disclose the results of its investments to its lenders. That was true because once it was loaned, the money belonged exclusively to Oasis. We again refer you to our video number 3, Ownership.
If Mr. DeCorta and his partners had no obligation to report the company's trading losses to lenders, how could lenders have been defrauded by Mr. DeCorta not doing so? They weren't. So why was Michael convicted of fraud?
The making and allocation of spread fees.
In forex trading, currencies like the US dollar USD, the British pound GBP, the Swiss franc CHF, the euro dollar EUR, the Japanese yen JPY, and all others, are identified with a 3-letter abbreviation, as shown here, and currencies are always traded in pairs, meaning that 2 different currencies are traded in the same trade with each positioned against the other. The reason for this is that the trader is placing a bet that one of the currencies will rise in purchasing power compared to the other. Thus, a trader will always be long one of the currencies in the pair and automatically short the other. Or, to put it another way, the purchasing power of one will increase over the relative purchasing power of the other, and the trader will be long on the one they expect to increase and short on the other. For example, if a long position is opened in the euro-US dollar pair, the trader is expecting the euro to gain purchasing power over the US dollar. They expect that the cost of a euro when purchased with US dollars will be more expensive than it was when the trade started. Price movements are measured in pips, an abbreviation for percentage in points, which in all pairs, except those that involve the Japanese yen, are measured as a 1-unit movement happening 4 places to the right of the decimal, like the number 2 is positioned here, 0.0002. A 1-pip movement in this example would produce a value of either 0.0003 if it went up a pip, or 0.0001 if it went down a pip. In the euro-US dollar pair, 1 pip equals 0.0001. So if that pair moves from 1.1000 to 1.1010, that equals 10 pips of movement up, which would be a gain for the euro trader. Understanding the spread. As mentioned, the spread is equal to the difference between the bid price and the ask price, and it's the cost a trader must pay to enter a forex trade, just like the ticket price is paid to enter a sports stadium, movie theater, or concert hall. For example, if the bid price is 1.0998 and the ask price is 1.1002, then the spread equals 4 pips, the difference between the two. When a trader buys at the market, they enter the trade at the ask price. Once the trader is in the trade, they have to earn at least 4 pips or else lose money because they paid 2 pips to get into it and another 2 to get out. So, in our example where the bid was 1.0998 and the ask was 1.0102, the trader paid 4 pips, so the price would have to move up to 1.0106 from 1.0102 for them to break even. As we explained, the spread fee is set by the broker-dealer that the trader will be doing the trade through. This will get very interesting when you learn how Oasis made over $51 million in profits from spread fee earnings. In forex, a so-called standard lot is a $100,000 position. Each movement of 1 pip in either direction in a $100,000 position is worth $10, gain or loss, depending on whether the price goes up or down during the trade. Thus, to enter a $100,000 position with a 4-pip spread, the trader would pay 4 pips times $10, or $40 to the broker, chart dealer, After their position is open, the market has to move in their direction at least 4 pips for them to break even before exiting the trade. Oasis's own broker-dealer set spread fees at 4 pips for all the pairs on its platform. As the total size of all loaned assets grew, Oasis's traders were able to take larger and larger positions. A TC Brokers London, through which the trades were cleared, allowed Oasis to trade on the collateralized value of all Oasis assets. Oasis balance sheet records show those assets were worth $55.3 million. By using leverage of about 2 to 1, Oasis could enter a trade position valued at $110 million, 2 times $55 million. Let's assume a trader enter a position with Oasis valued at just $10 million and see how much that would earn in spread fees for Oasis. Because a standard lot equals $100,000 and each pip is worth $10, then the trader would pay a $40 spread fee to Oasis's broker-dealer when a position of $100,000 was opened. Let's scale that up to a $10 million position. $10 million equals 100 standard lots, 10 million divided by 100,000. Multiplying 100 times the standard lot fee of $40 equals $4,000 in spread fee paid to Oasis. In the same way, a $50 million position equals 500 standard lots equals a $20,000 spread fee paid to Oasis. Keep in mind that this happened with every trade. The spread fees earned only depended on the size of the position and were always profitable to Oasis. There were no losses stemming from spread fee earnings. Imagine Oasis earning profitable spread fees several times a week, or even several times a day, and you can see how they could accumulate to $51 million over time. When 25% of Oasis's spread fee earnings for a given month equaled more than 1% of all loaned funds, then the lenders were promised a proportional share of that money. Here's an example. Let's say all loaned funds equaled $50 million. 1% of $50 million is $500,000, so 25% or 1/4 of the spread fee monthly earnings would have to be more than $500,000 for Oasis to pay a lender more than the promised minimum 1% interest that month. Now imagine that in a particular month, the spread fee earnings were $2.5 million, with $50 million in loans Oasis owned. $2.5 million divided by $50 million equals 5%, 1/4 of 5% equals 1.25%, which of course is more than 1%. Thus, according to the promissory note and agreement, each lender would receive a 1.25% increase added to their account balance at the beginning of that month. 25% of the $2.5 million earned, or $625,000, would be paid out proportionally to each Oasis lender. Oasis would keep 75% of the $2.5 million earned through spread fees for its other uses. Supposing a lender's monthly opening balance was $500,000, then they would earn $500,000 times 1.25% or $6,250 that month. If the lender didn't withdraw anything, as most didn't, the new total would be rolled over to start the next month, which would open with a new balance of $506,250, and the process would repeat itself again at the end of that month. When Oasis International Group began this program, someone asked if a lender should be concerned about the legitimacy of the model that Oasis was using to repay its loans. The answer was no, there was no need for concern, but it was peculiar for the company to promise to pay a potential share of its spread fee profits to lenders rather than to keep them all for itself. No other broker-dealer was known to share its spread revenues like Oasis promised to do, on condition that 25% of them was equal to more than 1% of the loans it owned. Tragically, the government's misunderstanding of spread fees, along with its ignorance of the promissory note agreement terms, which authorized Oasis to make proprietary trades free of CFTC authority, opened the door for careless, overzealous government prosecutors to file the civil case for fraud against the company and to prosecute its co-founder and CEO, Michael DeCorta, for frauds he evidently did not commit.